I want to start by welcoming everyone to our 24th annual CPE Day for CPAs. We certainly appreciate your taking the time to join us for this day of continuing education and networking. We know a lot of people enjoy coming here and connecting with professional colleagues. You know, we continue to do this in appreciation of our clients, our referral sources, and the friends who have helped us to get where we are today. Collectively, our firm now numbers approximately 100 personnel in 4 primary disciplines: audit and accounting, taxation, ERP, business valuation, which includes litigation support. We would like to continue to expand our practice, and to do so, we do need to hire additional people. I would note that if you look at the back of your agendas today, we have some positions that we're looking to fill, and you can also go ahead and look at www.gyf.com to look at the experienced hires that we're looking to join to our firm. Our professionals and guest speakers today have put together a program that we feel you'll find useful in your professional roles. Our first presentation today, Let's Make a Deal. An area in which our firm does a lot of work is in the business transaction arena. Most recently, one of our longtime clients was sold to a large public company. Trading off the skills of our experienced personnel, we're able to assist companies with transactions. So those are companies that are looking to grow via acquisition, and they're also companies that are privately owned and are looking to sell their business to a third party or to the next generation. Our first session relates to issues related to buying a business and is presented by Mark Wolstoncroft and Amber Pinskey of our A&A group and Don Johnston of our tax services group. So I'm going to ask them to come up front and get started on our first presentation of the day.
Good morning, everybody. Good morning. First off, congratulations, everybody. You made it here by 8 o'clock. Give yourself a hand. It's a big deal. Second thing before we get started, John mentioned something about a photo booth, and we really want you to do that because nothing goes viral like a bunch of accountants taking pictures together with their arms around each other going for the camera. So please do that. It'd be interesting to see how many people actually do that. So for the first time, I think this is our 25th time we've done this, 24th time we've done this. I'm not sure if we've ever had a situation where we've had tax and audit on the stage at the same time. But, you know, we agreed to work together, put on a good show. We did talk about it in advance. One thing Mark is not allowed to do is talk about revenue recognition or mention it. And one phrase that I'm not allowed to say is don't let the tax tail wag the dog. And with that said, we agree to work together.
It's like the dark side and the light side working together here, Tom.
For the betterment of everybody in the room. So the first discussion that we're going to do is, like John said, talking about transactions. We're going to do a session about buying a business. That's the first session. And we'll do a second session, which is our 10-15 session, which is selling a business. And a lot of the things that we're going to talk about kind of overlap. Things overlap. You're buying a business. There are a lot of things you do when you're buying a business you would do when you're selling the business, including some legal things and some accounting things. But we're going to talk about some things. We have a lot of transactions. We consistently have a lot of transactions. I would say at any given point I could have 10 transactions at some stage of, you know, of their development. You know, whether it's something we're talking about with a client, or a client comes to us and says, hey, in 10 years we're going to sell. We know we're going to sell in 10 years. In 2 years we're going to sell. Or occasionally we get a call from a client that says, hey, we have an offer for the company. We need help. So we have a lot of experience doing that, and we enjoy it. It is challenging, but you know, you never know what's going to happen. You never know if it's going to be a good transaction or a bad transaction. So one of the things we want to talk about today is some of the, you know, we'll tell you some of the war stories, some of the problems we've had, some of the blunders, and we'll also talk about things we look at from a tax side when we get that client call, things we look at from the audit side when we get that call from a client, both on the buy and the sell side. Okay, so just as a little introduction, and it's kind of hard to see the screen, so I apologize for that. I'm used to having the screen behind us. I think this is the first time we haven't had the screen right behind us, so I got to get used to it. So the first session, like I said, is buying the business. Second session, we're going to do a 10-15. Thank you for that. They're making it bigger as we speak. The second session is selling a business. We'll have a recurring fact pattern. For the most part, when we give examples, we're going to assume that either we're buying or selling a corporation. Corporation has $10 million of revenue and about $1.4 million of net income. So that's kind of like the fact pattern we're going to use as we go through this morning. One of the most important things when clients call and they're thinking about buying or selling, one of the most important questions I have is, well, one, what stage are you? Do we even have a letter of intent yet? If we have a letter of intent, what's the agreement? Is the agreement that we're going to buy the stock or sell the stock? Or is the agreement you're going to buy or sell the assets? So that's one of the main things. And it's that does change everything. Because if I'm buying the stock of a company, it's very different than if I'm buying the assets of a company. If I'm buying a stock, I have more due diligence because I'm stepping into the shoes. I'm buying the stock. All of the problems, all of the skeletons in the closet, since I bought the stock of the company, those become my problems because I bought the stock. Whereas if I buy the assets of a company, I'm buying the specific assets. So I'm only concerned with those specific assets that I'm buying. That doesn't mean that I don't have to do due diligence just because I'm buying the assets. I still have to do due diligence. I still have to pay attention to the company. I'm still going to do a quality of earnings because I need to understand what the company can really do from a financial point of view. And obviously, the reason we're buying a company, the reason you're looking to buy a company is because you're looking to make money, right? You're looking to expand your current operation. Or in some cases, it's just, hey, I'm tired of retirement. I want to buy a company. And that happens also. So from a buy side, we're going to talk a little bit about that. And then from the sell side, we're going to talk about that. So a couple things, critical points. This is on both sides. We're going to specifically talk about the buy side for this first hour. But critical points, legal issues. Legal issues. You've got to make sure when you're buying that you're paying attention to what you're buying. You need to have good legal counsel. Mark's going to talk about gathering a team and getting the right team to go through the process. But legal issues are critically important. If you buy the wrong company that has legal issues, it could completely change the future of that company. So it's always important to be thinking about legal issues and have the right team. Reporting issues. There's a much different reporting if I buy the stock of a company versus if I buy the assets of a company. In most cases, when we're working with transactions, folks are going to the bank and they're borrowing money to buy these companies. So, there are often reporting issues because the bank requires you to do audits. And obviously, tax issues, very important. When you're buying a company, it's very important to understand what the tax issues are going forward. If I buy a company that has, if I'm buying the stock of a company and they have depreciable assets and they have zero tax basis in those assets, the purchase price is going to be much different if I buy a company that has $10 million of tax basis in their fixed assets. Because that $10 million provides me tax deduction in the future, right? Whereas if I buy a company that has zero tax basis in those assets, I have no tax basis, or I have no depreciation of those assets in the future. So it's important to understand things like that. And those are things that we look at on both the tax side and on the audit side. Valuation of the company, what's the value of the company? Am I paying the right price? A lot of times you're using multiples of EBITDA. The question is the EBITDA calculation right? And that's why Mark does due diligence. That's why Mark goes in and does the due diligence to make sure that the financials make sense before we buy a company. And then the last thing is purchase accounting. Mark will talk a little bit about purchase accounting during the presentation. And purchase accounting, it has significance on the audit side, obviously. And whether you're buying stock or assets, Mark, you're doing purchase accounting, right? Your balance sheet changes because of purchase accounting, because of what you buy. And it is important for both a stock deal and an asset deal. It's also important on the tax side. Now, if it's a stock deal, the purchase accounting isn't as important on the tax side. We have to understand what's been done on the audit side. But on the tax side, since we bought the stock, we don't get a basis step up. We don't change the balance sheet that we just acquired. Whereas if we acquire assets, we have a brand new balance sheet, we get a basis step up, and all things are good in the tax world.
Yeah, thanks, Don. You can just stay on this slide for a second. I'm going to touch on valuation and purchase accounting for a minute because much of the first part is a lot of the work that Don does and the tax group does. But But valuation is really something that gets addressed in conjunction with due diligence. And it's obviously something you want to be thinking about when you're buying a business, right? You want to pay as little as you can for it. You don't want to overpay for it. And it's important to understand the value of the business that you're purchasing. Sometimes that's wrapped up in the assets of the business, but for most of the businesses that we work with and that we help with diligence, the value is really mostly tied up in what the expected future earnings of the business are. And so in conjunction with diligence, we can really get at the heart of that. I mean, that's often much grayer than just looking at the financial statements and looking what EBITDA is as reported in the financial statements. A lot of times there's some noise there. Sometimes there are personal expenses that are flowing through a set of financial statements. Sometimes you have a seller that's been tax motivated the whole time they own the business and may have written off things that normally wouldn't have been written off. Or they may have known the transaction was coming and they reversed some reserves and created some non-cash income that really isn't indicative of the future earnings power of the business. And so that's all stuff that we'll look at in conjunction with diligence and that Amber will talk a little bit about a little bit later in today's presentation. And when we talk about purchase accounting, I think that's also a critical point when you buy the business is getting that purchase accounting right at the beginning. Because after you buy the business, there's often more eyes and more critical eyes on the financial statements than there may have been before. If you borrowed money to do the transaction, the bank might be more interested. If you invested more money to do the transaction, the investors might be more interested. And just folks that were involved with the acquisition are interested in measuring, how it's going. So getting that beginning balance sheet right is important. A couple things to think about there. If you miss recording some of the beginning liabilities in the purchase accounting, and then those amounts get paid and expensed in the post-acquisition period, it's going to make your business look like it's not doing as well as it is really doing, right? So you want to make sure you get all the liabilities recorded at the beginning, and vice versa. If you recorded too much liabilities or if you recorded reserves that were too high and you reverse those in the post-acquisition period, that can result in earnings that look better than they should. So getting that beginning balance sheet right is important. Some other important things to think about, in the purchase accounting are how are transaction expenses being treated. For GAAP purposes, those get expensed. To the extent you have costs associated with the debt issuance costs, those costs get essentially capitalized and reported net of the debt. And also when you think about non-recurring expenses, that's something to think about post-transaction as well. If you have some costs associated with things that resulted from the business acquisition but aren't really indicative of the operating performance of the business, often you want to make sure you carve those out separately so that there's a clear sign of, hey, here are costs that we incurred as a result of buying the business that are non-recurring costs that we don't want to think about in terms of operation of the business. We'll cover purchase accounting in more detail a little bit later this morning, but those are some high-level things to be thinking about relative to purchase accounting. There we go. So what are what steps are critical before we purchase the business? Talk a little bit about that. First, you're going to need to build a team. If you're looking to buy a business of any significance, you're probably going to want to have a team involved with that acquisition. And that team is going to involve both internal folks in your organization and likely some external folks as well. When we think about internal folks, some folks that I think about are, you may want to have some operations folks involved in evaluating the purchase of the business, especially if it's in a line of business that is similar to what you're currently doing. Definitely going to want to have some accounting folks involved. You're probably going to want to have some IT folks involved to understand what systems are operating at the business, at the target, what systems you're using and how those might integrate after the deal, what kind of spend there might be to get on the same systems or to figure out how to get those systems to play well together. You may want to have some sales folks involved, and there's a variety of other folks you may want to have involved for various reasons. I think there's two really good reasons to do that. One is having people from different backgrounds in your organization contribute to the thought process can really provide some diversity of thought, can provide some good ideas relative to what to be thinking about for after the transaction. And then also, I think having those folks involved prior to the deal closing gives them some ownership of the deal afterwards. And that ownership can really increase your odds of success after the transaction. We talked a little bit on the last slide about assessing value. That's certainly something that can be addressed in the diligence process. One thing to think about there, whether you're on the buy side or you're on the sell side, is just to remember that when you're looking at a business, and if you're looking at a business that is a strategic purchase for you, you may be willing to pay more than a financial buyer. And when you're looking to sell your business, somebody that's buying it for strategic reasons is probably going to be willing to pay you more than somebody that's just a financial buyer. So, on the buy side, it's helpful to know kind of who your competition is in buying the business. And on the sell side, it's really nice if in advance of selling the business, you can identify, a strategic partner that might be willing to purchase the business in the future. In terms of deal structure, obviously Don touched on stock deals versus asset deals. That's really, really important. Don and his team do a lot of good work in structuring deals to make them as tax efficient as possible, both for you as the buyer and for the seller, in order to achieve some really good outcomes. And so that can't be understated, the importance of the deal structure. Sometimes you can consider earnouts. If you really like the business and you really want to buy the business, but you think there's some risk of how well they're going to execute in the coming years, you can pay a certain amount up front, and then you can do an earnout that you will pay over time based on the performance of the business. So that's something that's definitely worth considering in some circumstances. And then another thing that needs to be thought about in conjunction with the deal is really there's two ways to deal with this. One, you can put some money in escrow. Some of the purchase price can go into escrow. And if the business doesn't end up being as represented to you during the process, you may be able to claw back against that escrow. If you don't want to do an escrow, something that's come into favor over the last 5 years or so is the idea of reps and warranties insurance, representations and warranties insurance, which can serve a similar purpose. If the business wasn't as represented, then an insurance company can step in and make you whole as a result of that. So definitely important to look at that when you're considering the deal structure and protecting yourself. Obviously, you might need to think about financing. One thing to think about with respect to financing is obviously getting a good rate is important, but it's also important to have a partner in terms of the banking situation that's going to be committed to helping you achieve your objectives. Not every acquisition goes exactly as planned, and you don't hit all the covenant targets every time. So having a bank that will work with you when that happens is also pretty important. And then obviously, from a big picture perspective, you want to think about evaluating opportunities and evaluating risks, and that's where diligence is critical. Amber's going to talk about accounting diligence. Obviously, legal diligence is important to make sure there aren't claims out there that you might be walking into. Environmental diligence might be important depending on the type of business that you're looking at. You certainly want to have a separate environmental consultant take a look at the environmental issues if that's the case. And then there are going to be a variety of other folks that might help you with diligence, whether that be, it might be industry folks. You want to take a look at the industry from a market opportunity perspective, and there can be a variety of other folks involved in the diligence process. What are some common problems and how to avoid them? First we have here poor accounting records and procedures. That's not uncommon when you're buying a business, especially if you're buying a business that's been closely held and maybe operated by the owner. Sometimes they can be very tax motivated and not really all that concerned with the GAAP accounting. And so there's definitely instances that you can uncover in the diligence process to help you identify accounting adjustments that might be necessary going forward. And that can be useful both for determining value, for negotiating, and then also for developing plans for how to address those matters after the deal is done. Just because they have bad accounting records doesn't mean they're not a good target, right? I mean, there can still be really good businesses that don't have good accounting records that you want to buy, but you probably want to have a plan for addressing those going forward. Diligence also can provide a look at the talent in the accounting function. We're going out to the business, we're making inquiries of the controller and the CFO, we're asking for information, we're making inquiries regarding the information that's provided. Sometimes we're doing some specific procedures that are akin to what you might do in an audit. And we have a lot of interaction with the CFO or the controller, sometimes the CEO during that process, and that can really provide you as the buyer some meaningful input into how equipped is the accounting team that is at that business to move forward with you into the future. And that can cut both ways. I mean, you can identify folks that just you don't think are going to be able to contribute meaningfully going forward, and you can also identify folks that are really excellent and you want to make sure you retain going forward. You probably want to try to avoid large working capital adjustments, and that's something that we also look at in conjunction with the diligence process. So if we just think about the deal flow for a minute, there's a letter of intent and there's a purchase price that's stated in that letter of intent. Hey, we plan to pay you X for this business, contingent on doing diligence. Oftentimes the level of working capital is not stated in that letter of intent. And then you go through the diligence process and we'll look at, hey, what are the working capital levels in this business? And where do we think you ought to set the target for working capital? Because when you get to the purchase agreement, there's going to be not only the purchase price in that purchase agreement, there's going to be a working capital target. And depending on where you set that target and depending on where the actual working capital lands, there's usually a purchase price adjustment that results from that. And so you don't want to have a big difference between that working capital target and the actual working capital that's delivered, such that, especially if it means that you have to pay additional money that you weren't planning on and might not have on hand. So I think that working capital analysis is an important part of the diligence process, and oftentimes something doesn't get thought about early enough in the process, in my opinion. And then lastly on this slide, we generally recommend to our clients to try to close on a date that's consistent with your traditional closing period. And the reason we say that is because, if you traditionally close on the end of every month, you have a good process for recognizing prepaids and liabilities and, really have a good accounting cutoff. If you close on the 21st of the month, there might be different liabilities than there are traditionally at month end. Let's say your payroll ends on the end of the month every month, and now you're closing on the 21st, and you have to figure out which payroll relates to the pre-acquisition period and which relates to the post-acquisition period. That doesn't sound terribly complicated to figure out the payroll, but when you multiply that by a number of different liabilities and prepaids and cutoff procedures, it can be cumbersome to figure out to close the period at a date other than the end of the month. So to the extent that you have control over that, it's nice to be able to close on your normal close the deal on your normal accounting closing date. Okay, just some objectives regarding diligence, and then I'm going to hand things over to Amber Pinskey. And here we have quality of earnings, which we've talked about. That's an important objective, is to understand the quality of earnings and what the real EBITDA of the business is. We can identify potential issues and opportunities during that process. And that really goes both ways. I mean, you can identify potential issues relative to liabilities. You can identify potential issues relative to EBITDA. You can also identify significant opportunities. If it's a tax-motivated seller, they may have $1 million of inventory in the warehouse that they don't have on the balance sheet, and that's something that you want to know in conjunction with the acquisition. Or they may be Amber and I work on a client that did 3 acquisitions last year, and the entities that they acquired often purchased exactly the same material that they purchased, but they purchased it for 50% more than our client did. So day one, when they bought those companies, they achieved some significant materials savings for all 3 of those businesses that they acquired. And then that when you identify those issues and opportunities, it can help you with negotiations as you're putting together the purchase agreement. And then you can assess the seller's team's culture, both the accounting staff and others in the organization, for whether they're going to be a good fit for your organization going forward. With that, I'm going to turn it over to Amber, and she's going to do a little bit deeper dive into specific procedures we might perform in diligence and some examples of issues that we encounter during diligence.
Thank you, Mark. So as Mark mentioned, the purpose of the diligence process is to really dive deeper into the financials, beyond the financials, and really gain a better understanding of the business and to identify any potential opportunities there. And so to do that, I like to think of it in terms of like an iceberg, the tip of the iceberg. So what you see above the water is the externally reported financials. You can derive so much from that, right? You can see what EBITDA was, you can do some calculations and have somewhat of an understanding of the business and its profitability. But the purpose of the diligence process is to really take a look at what's below the waterline. What are the different pieces of the business that make it operate well? What are the potential opportunities there? What does their accounting team look like? What do their internal controls look like? Their accounting policies, what are the policies in place that support the numbers that they reported? And then really, what on a granular level do those numbers look like? Normally, external facing reports are either going to be quarterly or most notably annually. So as part of the diligence, we're going to really look more specifically as far as, in most cases, on a monthly basis and look at the financials there. So we will look at external financial statements, but beyond that, we will request things like accounting policies and manuals. We'll look at internal controls. We might look at significant contracts, whether that's contracts with customers or contracts with suppliers. Any other really significant third-party agreement we're going to look at that'll help to better understand the business, how it's operating now. Maybe they have a really strong customer concentration, but their agreement with them expires in a year. What is the likelihood of that agreement being renewed, or is it potentially that you're going to lose that business? So those are the types of things we look at. We will also just look at the business overall. What industry is it operating in? What are the trends there in the industry? If they are exclusively a brick and mortar business, The pandemic, I think, really forced a lot of businesses to go virtual and have the online representation. Have they explored that? Have they invested any money in that? Like, where are they in that process? Those are the types of things that we'll ask and we'll look to compile in our diligence report. We will also look closely at accounting policies. So Don mentioned that him and Mark had a handshake agreement about not mentioning revenue recognition. I did not shake Don's hand, so I am allowed to bring up revenue recognition because that really is a very important part of the diligence process. We will look at what accounting policies do they have, and also have they been consistently applied over the evaluation period, because that's important as well. Significant areas in the financials, we're going to look closely at that. Anything with a significant estimate, so think AR, receivables, accruals. We're going to pay close attention to those, what those policies are. Are they accruing things evenly over the year, or is there lumpiness in their accounting records? Are they only recording things at year end? These are all things we will look at as part of the diligence. We will also evaluate if there are any related party relationships, what those relationships and those transactions look like. It's important to understand that, to evaluate, are those relationships going to exist post-transaction? And then also, if the transactions were above or below market, or if they are in line with market. A good example there is rent. So it's possible that the operating company does not own the facility. The facility is owned by a separate company, which is also fully owned by the same owner, but for different reasons, they set it up as a separate legal entity. So they'll charge related party rent. We'll look at that and say, is that rent in line with the market? Is it above or below market? Because sometimes we do see that for varying reasons. And then we would also, inquire, what is that going to look like for the deal? Is the property going to be included in the deal? Potentially that's a negotiated item. Or is there going to be a rent agreement in place post-transaction? And how does that rent expense compare to what the reported earnings or what the reported expense was for the period under evaluation? All right, so now that we've talked a little bit about the operation side of the business, we're also going to look now at the numbers. As I mentioned, we will look at this on a more granular level than just annually. A lot of times we will request the financials and the general ledger and trial balance on a monthly basis, so that way we can compile the information over the evaluation period and really assess if there are any trends that we see. The look back for the evaluation period can really vary. I know with the pandemic, for a while there it was very weird because we had the impact of the pandemic, so we had to actually look back to like 2018, 2019 to get a sense of what did the business look like before the pandemic, what was the impact of the pandemic, and now what does it look like post-pandemic. I would say more frequently it'd be like a 2 to 3 year look back, although it can be more. We will look at both the income statement and the balance sheet on this detailed basis to try to identify trends. From a revenue recognition standpoint, we will inquire about, we'll look at their revenue and the gross margin by business line. We'll look at it by product line, by geographic location. Just depending on the business, we'll kind of be able to evaluate and assess like what buckets does it make sense to look at. But then we'll also look at their relationships with their customers, any contracts or any agreements that will transfer over. If they've recently affected price increases, how often do they affect price increases? How was that received from the customer? Those are all kinds of questions we'll ask and look to gain an understanding on. And then we'll also look from a revenue recognition standpoint, like how are they recognizing revenue? What is their transaction price? What does that look like? Another thing we'll look at is backlog. That's really important. And then also try to understand why there is backlog. Is it capacity issues? Is production issues, scheduling problems, things like that. On the operating expense side of things, we will look at the historical information and try to identify trends. We'll also see if there's any abnormalities, because that could be an indicator that there should be some type of diligence adjustment. If a certain expense category was unusually high in one year, we would ask about that, gain an understanding of that. It's possible that that's a unique, like non-recurring expense that should be added back in. Similarly to the income statement, we'll look at the balance sheet from an analytical perspective. We'll do ratio analyses, and we'll pay particular attention to those areas that have significant estimates, because those can be manipulated, as I think Mark mentioned. If you've historically had some pretty aggressive, let's say, inventory reserves, and then the seller knows that he's going to sell the business, so he clears out or reduces those reserves and artificially inflates his earnings. So we'll look at that as well. Mark already mentioned the importance of assessing working capital as part of the diligence process, because really that's going to help to identify the target, and really that's going to help to tell the prospective buyer what is the working capital cost of running this business. And then we have the final piece of the accounting diligence is going to be the quality of earnings analysis, and really all of the procedures and the analyses and the ratio analyses that we talked about are going to feed into this quality of earnings analysis. So we're going to take the unadjusted or reported EBITDA, and we're going to consider any pro forma adjustments to really derive what the value of the business is. And then lastly but not least, there will be tax diligence. I'm going to save that for Don, but that is equally as important. Okay, so now that we kind of have an overview of what the diligence process looks like, we wanted to go over a few examples. So Mark already mentioned this, but if the seller is very tax motivated, it's possible that inventory could be misstated, which would also misstate EBITDA. So think of an example where we've come across this before, where the previous owner did not record inventory on their balance sheet. All of their inventory purchases were just charged to cost of goods sold. So in years where they were very profitable, they would buy a lot of inventory at year end and reduce their taxable income. Going in and discovering that's not only misstating EBITDA for the period, but that's also misstating the balance sheet, right? Like there's presumably a lot of inventory on hand that would be included in the transaction. An adjustment like that we may or may not be able to quantify as part of the diligence, but that is something that you would definitely quantify in conjunction with closing. Like you would have a physical inventory count, assign a value, and you'd be able to quantify how much inventory you actually purchased. I already mentioned the areas with estimates are particularly sensitive just because they can manipulate it, and when they know a deal is in the horizon, they might be a little less conservative than they historically have and maybe reduce some of their allowances or reserves. And then revenue recognition. Again, Don, I think he's keeping track of how many times I'm saying that. This is a big one though. So we actually had an instance where revenue was not being recognized properly in accordance with Topic 606. So the previous owner, had received a large, several $million payment in advance on a contract. They took that payment, they recognized it as revenue, and they ran with it. Now, the prospective buyer is coming to buy the business. Not only do they not get the cash benefit of receiving the payment from the customer or being able to recognize the income post-close, but now they also have this liability. They have to satisfy the contract. They have to provide the service or provide the manufacture the product, whatever it was. They're on hook for that. So that really is an unrecorded liability. That's some form of deferred revenue that should be recognized. So if they're not recognizing revenue properly, that could uncover a big adjustment as well. Sorry, I don't think my clicker is working, but there's a delay. Did that shift yet? Okay, it didn't change down here, but I thought it did. Okay, so we have a lot of examples listed here. I don't have time to go over all of them, but just a few more I wanted to touch on. Non-recurring expenses, so I briefly mentioned that, but if there are certain expenses in the evaluation period that are not a part of normal operations of the business, maybe they incurred a lot of expenses to implement their ERP system 2 years ago, and those expenses wouldn't be recurring on a post-close basis, so that might be an add back. Similarly, there might be seller lifestyle expenses. So let's say the CEO would take a personal jet to travel to their different locations where there are commercial flights available and probably much more affordable. So those are things that we would consider that the personal jet expense might be added back. The cost in excess of the commercial flights would be added back. Another big one is the final item here I have on the list, deferred CapEx. So let's say the owner did not invest in keeping up with the equipment. It's still operating perfectly fine, but it probably only has another 2 to 3 years left of its useful life before it's going to need to be replaced. There's not a gap, by definition, gap liability to replace the equipment at the closing date, but that will be a future outflow for the potential buyer. So that is something you'd want to be aware of and you'd want to factor in as well. Okay, so here we have an example of a quality of earnings report. And again, I mentioned it just takes like the reported EBITDA, which I recognize is not a GAAP definition, but I think everyone in the room knows what EBITDA is, and adjusts it for seller proposed adjustments and then also diligence or the buy side adjustments, so the adjustments we discovered as part of the diligence process. Interestingly enough, in this example, all of the seller proposed adjustments serve to increase EBITDA, because I know it's going to come a shock to you all to hear this, but sellers think that their company is worth a lot more than what it shows on paper, right? So they're showing you why it's worth more here. And we came in as part of the diligence process on the buy side, and we're like, okay, we can get behind some of these entries, but there are likely, realistically, some adjustments that would go the opposite direction as well. And the one in particular I want to highlight is here the seller said, hey, I'm the CEO, I've taken a way above market salary over the last several years. When you get rid of me, when you take the keys, you will hire someone and their market compensation would be significantly less. So here they're adding back $240,000 a year because they say that's what above market their salary was. Okay, we can get behind that, but what is missing? What was the CEO doing that maybe other people in a normal structure would do? Well, in this case, they don't have a controller or CFO. The owner was really handling all of the reporting himself. They have a bookkeeper or a clerk, but no one sophisticated enough to handle the reporting to the banks that's going to need to occur post-transaction. So we recognize, yeah, we'll give you the add back for the $240 because your salary was above what market would be for a CEO, but we're also going to need to fill a new role. We're going to need to hire a CFO or a controller. Maybe we'll need to hire a sales manager because the CEO was also involved in that. So we're going to have an offsetting decrease to EBITDA because these are new salaries that weren't in place during the evaluation period. Okay, and then the final slide we have here is, so post-close, the diligence process is over. What are things that are important to do following closing? So the first would be accounting integration. So you would need to look at the ERP system. Is it sophisticated enough? Does it work well enough with your current system in place if you have a portfolio of companies? Or is it something that needs scrapped altogether? This would have been discovered during the diligence process. As we discuss internal controls and everything, we would already develop an understanding and tell the prospective buyer what their system looked like. So they would already have a plan, but they would need to implement the plan now. Similarly, they might have to restructure the team, look at any vacancies. In my example, they need to hire a CFO or a controller, someone like that. The sooner you can get someone in, the better. Mark mentioned some synergy opportunities with our one client who could buy the product for cheaper. Again, as soon as you close, as soon as you can start to implement those and get those into operations, the sooner you'll realize the benefit. Purchase accounting is also very important to get implemented and get it recorded right away. Mark is going to go over some examples in the next session, so we'll actually talk more specifically about that. And then the working capital settlement. So if the purchase did have a working capital settlement at close, the seller would prepare their closing working capital settlement, and then the buyer would have an opportunity, it would be a set amount of time, depending on how the deal was structured, to prepare their own working capital settlement. Once they get a chance to look at the records and see, like, okay, what inventory did we actually receive? What receivables did we receive? And so part of the first things you would do would be evaluating working capital and then preparing that statement. And then finally, the bank compliance. So if the deal was funded by some debt, you would now have reporting requirements. Maybe that's monthly reporting for covenants, maybe it's quarterly, whatever the deal is, you're going to have this now formal reporting requirement that you did not previously have in place. So it's important, really, that you get a good team in place that knows what they're doing so they can help to set the processes up in place right with the first month, so that way you know how to report to the bank knows what to expect, and you can just get in a good rhythm. And with that, I will ask Don to come back up, and he's going to talk to you about some tax diligence.
Thank you, Amber. So just a comment, it's important to understand that when you're going through this due diligence process, it is very possible, and it's probably likely, that the majority of the people that you need to talk to, or many of the people you need to talk to, don't even know this transaction is going to happen. So there's obviously confidential issues that we have to be aware of. And we know that going into the process. But a lot of times when a client calls and says, hey, we're selling the business, a lot of times very few people at the company know about it. So confidentiality is very important. We understand that going into it. So that makes the due diligence process a little bit harder in some cases. So on the tax side, when we're talking to due diligence, okay. So on the tax side, when we're talking to due diligence, there's a difference between due diligence if we're doing a stock deal versus an asset deal. If we're doing a stock deal, the due diligence is much more in depth, much more detailed, because we're basically stepping into the shoes of the seller. So we are paying attention to more things, whereas if we're just acquiring the assets, the due diligence can be a little bit less. When we have that stock deal, some of the things we're looking at is underreported or understated tax obligations. Are we filing in the states that we should be filing in? In many situations where we see due diligence, it's rare where you're going to find a due diligence report on the tax side where somebody doesn't come up and say, well, you should be filing in 6 other states. That is not uncommon. We know that that's the case. And because that's the case, when we're on the sell side, we got to make sure we're filing in the right states. But are you filing in the right states? And you have to think about not only income tax issues, you have to think about non-income tax issues, like sales tax issues. Can you imagine buying a company, you buy the stock of a company, and they have never collected sales tax, and their product is subject to sales tax. And then all of a sudden you buy the stock of the company, it's like, oh, we should have been collecting sales tax, and you start collecting sales tax. As soon as you file that first report with Pennsylvania Department of Revenue, they're going to come back and say, wait a minute, you haven't filed a sales tax report for the last 27 years. What about sales tax for the last 27 years? Since you bought the stock, that becomes your issue. That's an important part of the due diligence process, is understanding things like that. Tax attributes. If I'm buying the stock of a company, I get the tax attributes. Let's go back to my example I talked a little bit about earlier. Let's assume I'm buying the stock of a company for $10 million. And they're on the accrual basis of accounting. They have $5 million of receivables. What happens when I collect those receivables on the tax side, since I'm on the accrual basis of accounting? I collect $5 million of receivables. I don't have any tax consequences, right? Because I've already recognized the income. Think about the same company. Think about the same company that's on the cash basis of accounting. I'm not going to pay $10 million for that company, because when I collect that $5 million of receivables, I've got $5 million of taxable income. So it's important to understand what the tax attributes are. Are there NOLs that are coming forward? Are there other things that carry forward from a tax point of view? Because I acquired the stock, those tax attributes become my tax attributes. A couple other things. If I'm buying the stock, I got to be careful, because if I'm buying an S corporation and they busted their S election at any point over the last 10 years, if they busted their S election, the IRS can come in and say, you busted your S election, you should have been a C corporation for the last 10 years, and now you have serious problems. So the S election and making sure they're still compliant with the S corporation rules is incredibly important when you're buying the stock. And like I said earlier, don't forget about non-income taxes like sales taxes, property taxes, other things that could be understated. Important bullet point here, if you buy the stock, you're basically subject to any issues from the beginning of time, okay? If you buy the stock and they have tax issues, you have tax issues. So it's important that you understand what those potential tax issues could be. Also, if you buy the stock, you're stepping into the shoes of whether they have, did they get PPP money? And if they got PPP money, was it legit? Because if it was a problem and they shouldn't have got that PPP money, that becomes your problem because you bought the stock. And ERC, how many commercials has anybody not heard the commercials about ERC over the last 6 months? I think it's slowed down over the last month or so because of some of the things the IRS came out with. But ERC is a big problem. We had a deal that basically blew up because of ERC. They were going through the due diligence process, and the buyer, which we were representing, wanted to escrow 100% of the ERC funds, which was well over $1.5 million. And the seller was like, no, we're not going to escrow that. And we did not think, we were not confident that they actually qualified for ERC. And without putting $1.5 million into escrow, we weren't going to do it. So that deal fell through because of ERC. So basically, the due diligence process is incredibly important, more important for a stock sale than an asset sale. So this next slide, it's exactly the same slide as this one, except we're talking about an asset deal. And you can see that these things are not an issue, either not an issue or not as important because we're buying the assets. So the second bullet point there, tax attributes. I don't care what the tax attributes were for the seller because since I'm buying the assets, my tax attributes start all over again. So if I pay $10 million for the assets of the company, when we do the purchase accounting, I'm allocating that $10 million to my receivables, to my inventory, to my fixed assets. And in many cases, because I get to reallocate that purchase price to my assets, my tax consequences for the first 2 or 3 years after the acquisition are very beneficial. Just think about my receivables. If I have $10 million of receivables, I collect those receivables 2 months after the purchase. I have no tax consequences. Now I have $10 million of cash flow with no tax consequences because my basis in those receivables is $10 million because I got a basis step up. The fourth bullet point down there, I said, I'm talking about sales tax. I said it can be a concern. So the reason it can be a concern is let's assume that the company never collected sales tax on any of their products. And now I buy the assets and I'm absorbing all of their customers. And now I start collecting sales tax. That could be a problem for my customers. Even though it's the right answer, it still could be a problem for those customers. So we have to be paying attention to stuff like that. Just a couple other points during the acquisition process. There's going to be more due diligence with a stock sale. Tax attributes carry over. We talked about that. And I did say earlier that there is more legal work associated with a stock deal because I'm stepping into the shoes and I'm responsible for the liabilities. On the asset sale, we have to be aware of whether there are any tax liens or any type of liens at all on the assets we're buying. It's very important, and that we go through the due diligence process and make sure we're covering that. The very last bullet point here is the allocation of the purchase price. When I'm acquiring the assets, there's going to be an allocation of the purchase price. The buyer and the seller have different goals with respect to the allocation of the purchase price. Turn me off for 1 second. Good. Sorry about that. The buyer and seller have different goals with respect to the allocation of the purchase price. As a buyer, I want as much of the purchase price allocated to my current assets, my receivables, inventory, fixed assets. From the seller's point of view, they want as much of the purchase price allocated to goodwill. Why? Because it's better tax consequences. It produces a capital gain as opposed to ordinary income. So the allocation of the purchase price, very important on both sides. Post-acquisition matters. Just a couple things to talk about here. On the stock side, I need to be cognizant of what the filing requirements are, because if I buy the stock, there may be a short period return for the company that I just bought, or depending upon how I buy it, there may not be a short period return. I have to be cognizant of that tax return, if there is a tax return, make sure I don't miss a due date. Because if I close a transaction on July 1st and that company that I bought has a short period return, I have a tax return that might be due 3 months after that. I need to make sure I don't miss that extension or get the return done on time. And it's important to understand, that the buyer needs to be responsible for those taxes on that particular tax return. I already talked about purchase price allocation, so we'll skip that one. Okay. A couple closing thoughts, important things to consider as we're going through this process of buying a company. Post-transaction timing issues, understanding when things are going to flip around, understanding when tax returns are due, understanding other things relating to the transaction that are now becoming my problem. Remember, I bought the stock, and if I buy the stock, I need to make sure the buyer and seller are on the same page as far as timing. I need to make sure that we're following the purchase agreement, whether it's a stock purchase agreement or an asset purchase agreement. I mean, we've spent many, many months getting to the point where we can buy the company, and we have an 80-page document that is the agreement. We've got to make sure both parties are complying with that agreement. What we generally do is once we have a transaction, we close it, we review the agreement in great detail, making sure we're understanding when specific things are due based upon the agreement. And just paying attention, making sure that we're covering things from the tax point of view, the filing returns going forward. So that's the end of this session. John is going to come up and introduce the next speaker. So our next session, which starts at 10:15, which Mark and I will tag team that one also, along with Ryan Feronius, we'll talk about transaction from the selling side. So it's up to you, sir.
Okay, thank you.
Do you want this?